Hi, folks. Welcome back. Today is Tuesday, November 19th, 2019, and this is another Crash Speculator opportunity to take a look at today, folks. We have today ticker symbol WHR. That's Whirlpool. And as you can see by our analyses here, we do have a fundamentally somewhat weak stock, but more importantly, we've got a stock that is decidedly now in a downtrend. We've got a sell signal that really kicked in on Whirlpool back in October, about October 24th or so. And ever since then, really, we've been in this downtrend. We're just sitting right now just above our 200-day moving average. And as you know, we've talked about this technically speaking in the past. That 200-day moving average acts sort of as a magnet with stocks. It's a really big barrier. It's a line in the sand, if you will. Stocks have a hard time breaking above and below it. But when they can, when they can unstick themselves from that 200-day moving average, it usually results in pretty big moves. And so we've seen it act as a big level of support here. It's acted as a little bit of a level of resistance back in here. We're sitting right on that level again. Where would the downside potential be in Whirlpool if we could go ahead and break down below that 200-day moving average? Well, our next level down is right here. Our next level down is at about 133, 134 area. Right in that area right there where our crosshairs sit. So with that in mind, we are going to go ahead and put on a bearish trade on Whirlpool, on WHR. And the way we're going to do this, of course, as we always do, is we're going to give you a couple of options to take a look at in terms of how you can go about approaching this. We're going to use our speculation trade, which is simply a pure speculation trade. Of course, it has a lot of upside and it has a low probability of success. And then we're going to use our pro level trade, which is the way that we recommend it, is the way that professionals trade these types of strategies and opportunities. It's a much higher probability with a lower profit potential. But I think you're going to see in this week's example that the profit potential is still pretty darn impressive. So let's talk about, first of all, the speculation trade, how we could put that together. If we go to our trade tab here in My Brokerage Accounting and Tastyworks, we're going to go look at an expiration date that is right here. That is the December 20th expiration date, just about a month out, 31 days to be exact. I'm going to go ahead and I'm going to click on that December 20th date, and we're going to go look at purchasing one of these options right here. That's the 135 strike price put option. You can see that they're bid at about 205. They're asked at 226. If I clicked on that to purchase that, you can see that the mid price on that is about $2.15. So a couple of parameters here. You can see, obviously, if we look at this in the curve, this is the nature of what a put option looks like. Right there, that little flag, that's where we're currently sitting. This is where our profit and loss graph would hit our break-even point right here. It's at about 133 would be our break-even. And again, remember, this is a 135 strike price put, meaning we would start to make money if the stock fell below 135. But of course, we have to pay for the option, which is going to be a couple of dollars. So really about 133 would be our break even on this. We would have a lot of upside on this particular stock if we were to be correct in our assumptions. I've got 100 contracts in here. Obviously, we don't want to do 100. We're going to look at doing just one contract here. But the risk graph looks obviously the same. So the numbers, again, very similar to almost all of our speculation plays. Probability of profit on a trade like this is only about 25%. Max loss, of course, would be what we would put into the trade, which would be just above $200. And max profit would be about $13,000. That's assuming, of course, that Whirlpool goes to zero. I would not anticipate that. Again, as we look at the chart patterns, we're saying, well, our near-term downside here would be about 133, and we would be able to utilize that break-even point down here to basically double our profit potential on the trade if we were able to hit that perfectly. So low probability of profit, 25%, but high profit potential on this. This would be our speculation trade right here. So we would be, again, purchasing one December 20th expiration date, 135 strike price put option. There's your speculation trade. I'll let you take a second to look at that, and then we'll go ahead and look at the pro trade. Okay, so taking a look at our pro trade, I'm going to clear this trade out here. We're going to do some pretty cool things here, I think, with Whirlpool. If you look at this trade, again, coming back to the charts, you can kind of see that right here, we're at that inflection point. We're ready for that to break down below that 200-day moving average. If we can, we have some pretty good downside in this range right down in here. If we have some upside move in this trade, in other words, if it goes against us, this is the number right here that we're looking at for resistance level in this trade. That's the 50-day moving average, and that's right at about that 154, 155 level. So with that being the case, step one on our pro level trade. Step one, we are going to come in here and we are going to purchase this 137 strike price put. So I want to buy one of those. I'm going to change the number down here to 1. Going to buy one of those 137 strike price puts. This should look somewhat familiar to you in terms of the risk craft and what it can do for us. Low probability of profit on a trade like this. Our max loss, of course, is the money that we all the money that we put up to buy that option. Max profit would be 13,000. That's again assuming that Whirlpool goes to 0, which was not an assumption that we're making right now. But you can see what the risk graph looks like. So that's step one. We're going to buy that put option. Now, step two is we want to do something to subsidize this expense, subsidize this cost of this option, so that if in fact Whirlpool does not come down here and we are not able to capitalize and profit from this put option, it doesn't hurt us financially because we've subsidized the cost of that option. And so the way that we're going to do that, I'm going to come back into the table here. We're going to come over to the call side and we're going to sell what's called a call spread to be able to generate some income inside of this trade. And the spread that we're looking at selling here is we're going to go sell the 152.50 calls, and we're going to go buy back the 157.50 calls. So this is a $5 spread right here inside of this, okay? So again, we're selling the 152.50s, we're buying back the 157.50s. And I'm going to highlight both of these because the quantity that I want to use in this is going to be 5. We're going to be doing 5 contracts. Now, if we go back and look at this trade in the curve, you can see that a couple of things have changed. Number one, our probability of profit. That's the biggest thing. Our probability of profit has shot to 80%, meaning even if this stock doesn't go down, even if Whirlpool stays at its current price or even goes up quite a ways, we're still going to be inside of the profit zone. So it's a much higher probability trade, bringing in some income now on the trade. If we looked at that trade, it would bring in just a little bit of income, still not enough really to justify doing the trade. So we're going to come back in here and we're going to do one final step. This downside potential, we're going to be able to willingly give up some of this unlimited upside potential in order to boost our income on this trade. So we're going to go ahead and give up some of that upside potential in order to be able to generate more guaranteed upfront income into the trade. And the way we're going to do that is we're going to come in here and we are going to sell one of these 136 strike price puts. We're going to go ahead and sell one of those 136 strike price puts. So again, 4 legs to this trade. Step one, let me get these all unhighlighted so we can look at them individually. Right there. Step one is we are buying the 137 strike price put. Step two, we're selling this call spread right here. We're selling 5 contracts of the 152.50s and the 157.50s. And then last but not least, step three here, we're selling the 136 strike price put, 1 contract of those. Now, if we take a look at all of these put together here, inside of our risk graph, that's a pretty darn good looking risk graph right there. If we take a look at that, you can see that our probability of profit is right where we want it to be. It's about 81%. Our max loss is everything that we are putting up in this trade. That would occur if we went above this level. We would, of course, exit before that happens. So we would not put all of that capital at risk of loss. Max profit 365. What do those numbers look like? They look something like this, folks. So again, we're looking at about a 1 month trade, and we're putting up about $2,200, $2,300 to do this trade. The mid price on this is about, after commissions, would be bringing in about $252 in income on the trade. That's better than a 10% return in a 1 month period of time. That's about a 135% or so, is my guesstimate. About a 100. We can take a look at it real quickly here. 252 divided by 2247. It's about an 11% return in a month. Times that by 12 months to annualize it. Yeah, about a 135% annualized rate of return potential on that trade. That's not too shabby. That's a pretty darn good trade. And so again, this would be our trade right here, folks. I'll let you take a look at that for just a second. Once again, right here we are buying one of the December 20th put options, 137 strike price. And then we're going to be selling 5 contracts of a vertical call spread. We're selling the 152.50s. We're buying the 157.50s. And then last but not least, right here, we are capping our profits by selling the 136 put. Now, once again, as I always say, it does depend on the trading platform that you are trading on. You may need to do these trades in 2 separate trades. You may need to do the calls in one trade, and you may need to do the puts in another trade. This is called a combo trade, and almost every brokerage account will let you do a combo trade where you're doing multiple legs at the same time. But sometimes if you, depending on your broker, if the number of contracts in each one of the legs is not identical, they will reject the trade. So you would need to do 2 separate trades here. You would need to do the calls, and then you would need to do the puts. But regardless of how you have to put the trade in, these are the exact trades that we are looking at doing. This is the exact cost that we are looking at. This would be the result of the trade. So there's your WHR trade for the day, folks. Definitely we prefer, obviously, the pro level trade. We feel like it has a high probability of success with a really nice potential rate of return, almost 135% annualized rate of return on that trade. So there's your trading ideas for today, folks. Have a good day. We'll talk to you soon.